everybody, to another Build Your Legacy Investing webinar podcast. Really stoked to have the man, the myth, the legend, Salvatore Buscemi, author of Raising Real Money Real Estate Funds Uncovered. And I don't know if you guys can see this. I only have the Kindle versions. Investing Legacy. Oh, there you go. Okay, cool. So really excited to have you on. For the audience that doesn't know you, man, really excited to have you here because you are, believe you have your own family office. You're into some really cool stuff, technology, and you know about fund creation and fund structures. I just listened to your book, so really excited to dive in. Why don't you introduce yourself, my friend?
Sure. My name is Sal Buscemi, and I've known Ruben for a while right now. And one of the things that I've specialized in has been, since leaving college, has been focusing on my passion of investing. And I was very fortunate enough to get a job in the investment banking division at Goldman Sachs in New York when I graduated college. And I write about that in my book and how I was able to do that. Since then, at the age of 29, what I did was I raised my first institutional fund from a Park Avenue investment manager in New York, which is like Fifth Avenue for fashion, but for capital, it's Park Avenue. And then after that, I headed out west. We bought a special servicer for $1 and recapitalized it with approximately $15 million. And we were buying a lot of these fractional interest hard money funds that had blown up in Irvine. And if you know anything about Irvine, like everything that's bad with America started in Irvine, no offense, but you have the Real Housewives of Orange County that became of that because everybody was a mortgage broker and a realtor. And there was a lot of extravagance. And, you know, when I used to go to Irvine back before I started my fund, my ex-boss at Goldman, Steve Mnuchin, went out there and he bought IndyMac. And I'm like, well, I'm going to do something on a smaller scale. So I sort of modeled him. But before that happened, everybody was driving like Ferraris and things like that out there. And it was very, very interesting. One of the things, though, after that is that after I finished my institutional fund, a lot of people wanted to know how to do this stuff. And I put together a book called Making the Yield. Hard Money Lending Uncovered. And that's basically how to start your own personal bank to be a personal investor and a personal lender to people. And that was very widely received. At one point, it was so high on Amazon, it was the most expensive book on real estate investing. Right now, I bought the rights back and everything. It was at one point $1,300, and it rivaled Seth Klarman's value investing book for you financial nerds out there. And then I wrote another book, which is a red book that Ruben has shown off here, which is great. At that time, what was happening is that we were being outbid on things, and I wasn't very comfortable holding investors' capital. So I wound up giving back about $19 million for what we were buying, with a bunch of what they call necessity retails. Think about like a CVS, maybe a little lower end. And from that point on, doctors and dentists who had access to free and cheap money, not theirs, but home equity loans and signature loans and what have you, were outbidding me on these things that were trading at like a 10 cap going back to Moses. But now these guys were bidding at like 7.5. So I gave the money back. I write about this in my book, Investing Legacy. And then I pivoted towards things, and it wasn't technology, Ruben, thank God, because technology is really in the crapper right now. It was earlier stage life sciences investing, because I had a lot of real estate family offices that were investing into these life science companies, and I developed relationships with other people. That was in 2016. Since then, and you can go to hrn.llc, we've invested in, I think, over 15 names. We've had one stinker, but that's not in the fund. That's something that's outside. That had to do with a little bit of an issue with the CEO dying. But one of the things that we have is probably the most world-class venture portfolio in life sciences and AI and some other segments in there too. And it's all relationship built on it. We were able to get into these deals relationship built. And for example, one of our companies, Avive AED, recently just got, and they were the youngest team out of MIT at the age of 27, to get FDA approval for what's called a PED. And basically now every mother and football coach in the country or in the world will have something the size of a Coke can in her purse or pocket, so that if any time an athlete or a kid hits the field with a cardiac arrest, you can use the power of your cell phone to juice them back up again. And that's something that's really, really powerful. And I'm an owner in that company, and everybody should have it. It's marketable now if you go to Avive AED. That's not the point of this, but you know, it's a social circumstance right now. So what we've done is during the pandemic, we put together, people were really worried, and we built, because I had partners that are very formidable in life sciences, Bill Workmeister and Albert Ewan, who you'll see on the website. Albert recently came from Rockefeller before doing a lot of the things, but he was managing about $6 billion at the age of 26 for the Rockefeller family office. And my partner, Bill, at the age of 26 we call him the patron saint of standardized testing. He's very good at due diligence, and he has a great track record, and he has 4 Ivy League degrees. And he is, at the age of 26, he was managing for the state of Texas, their venture life science portfolio for their pension funds, and then later in New York. And then he was managing funds for the National Institute of Health. So when you combine this together, the network is really unparalleled. And that's what we've been able to do, is to help what we call people not just get richer, but build a legacy. These are people who already have a lot of wealth and they're looking to build a legacy. So we have venture, we have real estate, we do other things in fine art lending we like doing, which is something a little more sophisticated and cosmopolitan. But I'm carrying out of my passion of just, investing in, and I'm seeing a lot of great opportunities coming up right now. And one of the reasons why I wanted to reach out to Ruben before I let you talk is because I recently moved to Florida, and I noticed that a lot of people here do not really have good bedside manners when it comes to raising capital. It's very pushy. Everybody's got an iPad under their sleeve, very pretty pitch books, but no depth. And it's sort of like they assault you because you have money. It's sort of like, or they think or know you have money. That's sort of like, we call it getting French fried. So I put together this guide, Ruben, and I think hopefully it'll help your listeners, because banks are not going to be lending money during a downturn, of course. So you're going to have to rely on raising that money privately. So that's my opening monologue. How'd I do?
Rock and roll. That was great. So Calling the Capital is a ebook that you're going to provide to the audience members. So we're excited to hand that out. We'll put the link in the comments, I believe, if not in the podcast that gets released. Yeah. Andy, what are your thoughts? Are we thinking too little? I mean, this guy's coming from Goldman Sachs. He's doing all kinds of, medical device. And my gosh. So I want to hear about the funds that you've created.
Gray hair, Salvatore. I don't see any gray hair, Sal. You've been through a couple cycles. You're in Miami. You look like you're in Miami. What's going on? What's the rub here?
The rub here, I live a very healthy lifestyle. I work out every day. I don't smoke. I don't drink that much. Although in Miami, it's very easy to go over the top here. It's a different city, and it's just, I've been very focused on doing things and really building something, because it's something that's really made me happy. I'll be honest with you, Andy. After my mom passed away 2 years ago, I was just so bored. I was so tired. Like, I rented a house out with some close friends at the time in the Hamptons. And then I finally called my publisher up and I said, all right, I'm bored. I'm ready to write the book. So then I went to the bank, wired her some money. And then that's how investing legacy became part of my repertoire, actually, right now.
That's awesome. Ruben, let me ask questions, because I know that you've got kind of a format here. We're going to get into maybe some of the fund creation, but I would love to hear a little bit about your outlook on kind of where we are, because I've heard you speak, maybe 6 months ago. So I'd love to hear kind of like your updated outlook on where we are economy wise, maybe global, even.
I think, that's a load of
things we've seen over the last couple of days.
Yeah, I think what's going to happen is that there's, and people don't talk about this, but if you're an insider and you look at the businesses as cynically as I do, and you grew up doing the buy side, what we call the buy side part of the business, you look at the world a little differently. And what I'm looking at right now is that you're going to have rising interest rates that are going to cause a lot of problems for newly minted apartment owners. People who had bought something within the past 2 years with low interest rates and overpaid for it are going to have problems, because the inflation that we're seeing as it relates to food, gas, and other eggs has affected the lower tier, what we call the workforce housing person. So those people who are in Class B are now going down to Class C. So you're starting to see things come down because people only have so much income and they can't put it all to housing. That's also going to stress as it relates to negative equity in the apartment side, because a lot of these people who overpaid, I believe, who overpaid for some of this stuff just to have the pride of ownership and are probably first-time operators, are going to get spanked because the banks aren't going to let them hold on to it. And there's going to be a lot of what we call technical defaults coming in. And then there'll be monetary defaults. If you look at it, it's the equity that's going to get screwed first, right? So, those are the guys who are the syndicators who, syndicate from people who they don't know, they can overpay because it's not their money. I'm not saying that's appropriate or not. I don't think it's appropriate. But those guys made their money, right? Because they're stealing people. But the problem is that the investors are going to be sandbagged in there, and those equity investors could be wiped out. I also think that you're going to see probably, and again, I don't want to you asked a question, I'm giving you an answer. I think that tech is leading the way down. And I think that we've come to the point right now where I think there's maximum saturation of how much social media or how much disruption there could be. And if you look at the IPOs lately of all these disruptive companies, they've caused a lot of problems, and as it relates to stocks. And I think you're going to see, and I don't want, and again, I'm just saying this because it's my opinion, I think you're going to see about 80% of those stocks just get reorganized into bankruptcy, depending on their capital structure and how much debt they have. I think you're going to see a lot of those companies just, you're not going to have the same amount of discretionary income that's flowing into those things to keep those things going. And a lot of them, I mean, even like there's a lot of fallen angels, like Intel today, for crying out loud, has decreased their dividend by 66%. That's huge. That's a bellwether. I mean, that is like the equivalent of like AT&T, Ma Bell, right? And all of a sudden Intel is cutting dividends. So that portends to opportunities that I like to say. What is risk, right? Risk is what your friends and family will make fun of you for if the deal goes bad. Who are you going to point the fingers to? And the risk here is rising rates. And if rates rise, who's going to get hurt? Tech companies, they're seen as being more low barrier to entry. The ones who don't get hurt are life sciences, because nobody lends money to an emerging life science company except for a very wealthy family office who is looking for that type of legitimacy and legacy to continue to build out their portfolio. It's not the same for, I think the middle class are going to get hurt the most. I think the people who are in stocks are going to get hurt. And if there's anything that happens, God forbid, over in Europe, then you're going to start to see some really bad things. I think there's going to be a sell-off. There could be like a flood or a move to treasuries as a safe trade. I think that's going to happen. But you also have a lot of issues too, where the dollar might not be the world's reserve currency anymore. And what does that mean for America, right? And you got to look at other threats too, such as oil. This country was not built, Andy, on $10 or for $10 a gallon gas. It's just not, and it'll keep people home. So there's a lot of things that are happening right now. And the first barometer, the first, the canary in the coal mine is always going to be the equity markets, the Dow Jones and all of that. And I think it's going to be a very interesting time to see what happens going forward, especially with a lot of the rhetoric and some of the news you don't hear about coming out that you hear about through fringe sources, whether that's Twitter or other sources, showcasing things that obviously the mainstream media doesn't want you to know.
Fascinating. All right, cool. So we're going to jump into
long-winded, wasn't it, Andy?
No, that's great. That's great. That's exactly what our audience needs.
Somebody's pissed. Somebody's like, what do you mean?
So,
Kevin's been saying that for years. So
one of the things that I haven't really contemplated as I scale in the syndication, the majority of the audience, just for your information, they're scaling syndicators, typically in the multifamily or commercial real estate. So we got a bunch of people that have launched funds or are first-time fund managers. Not anybody, I don't think anyone too much from my audience has gone into becoming a family office. So that's something I'm very curious. We're going to talk about managing a family office, scaling into managing a family office and becoming one. I'm not sure what we all need to know about that, because eventually some of us are going to get there. And then we can talk about some capital raising tips and tricks and mistakes.
I think that's a great idea. Yeah, I'll follow your lead, Ruben. You lead this dance.
How about we start there? Because you didn't have a family office when you got started. You you scaled into that. What did you learn along the way about becoming a family office? What do we need to know?
When you become a family office, Dandrew Partners is my own family office, and I have a few other families that I've known who have watched me grow up since leaving Goldman Sachs, and I invest on behalf of in real estate stuff. And it is really amazing, the differences. When you're working with a fund, remember you're working with a bunch of investors, right? When it's your family office, it's mostly your own money and other people's money too. And it has a much different, what we call alignment of interest, if that makes sense. So we're all in it together. Whereas if you're an operator, you have to hit a hurdle in order to get the promote or something in some of these value-added real estate deals. But with a family office, it's different because that money has a longer duration on it, because everybody knows that it's for the long term or not, and it's differentiated. Now, legally, they're structured kind of the same. I have a smaller balance venture fund we started investing into a lot of these emerging preclinical biotechnology life science companies back in 2000. I think it was 2018 on Christmas Eve we launched, and we've had a great portfolio in that, and it has a vibe and everything in it. But that's a fund structure, and those fund structures are very difficult to administer if you don't know what's happening. And what we use are very single purpose SPVs because we want to make it discretionary. So if in the case of HRN, for example, if I'm going out to families and, we're talking about Thrive Bioscience or, a company that we were investing into that, the co-founder is Dr. James Allison, the 2018 Nobel Prize winner for physics or medicine. We just set up a separate SPV. It's a lot easier that way because when you're working with investors today, especially higher net worth investors, they're going to be much more attracted to making direct principal investments into these deals rather than going into a fund. Funds are great when you're buying pools of assets and things like that, However, in real estate, you don't need a fund. You need like a joint venture structure mostly. And that's what a family office looks like, is a joint venture structure.
So when you're managing funds, and if Andy was asking the question, I'm sure he'd like to know, what did you learn? What kind of huge mistakes did you make? How did you recover? And, what did you learn from that you won't do in the future in terms of managing your own fund? I mean, and then particularly around real estate funds, because that's what
here's
the
why.
audience
I'll
is.
tell you what it comes down to. It's the real question is, what did you learn about having a fund? If anyone who has a fund before, who's ever run anything, you know that there's a convention called cross promotes. All right. And I'll put it in a baseball comparison here. Let's just say we do one deal, we pull, let's say it's a $10 million fund, and we have 5 allocations at 2 million apiece. And let's just say we've made 3 allocations. One of them is a donut. All right. The guy, just something, it didn't happen, and we wound up having to deal with it and bankrupting or something like that. But the other one's a home run, and then the other one's a first base. Okay. So at the end of the day, your average is really not that great, is it? So what we do is we don't use that structure anymore. We use a master series LLC to be able to do that, so that none of the performance is crossed. Meaning if you strike out over here, it doesn't affect the interest over here. Because remember, when you're working with a fund, if you're the sponsor, or if you're the fund manager, especially if you're working with institutions, and that's my experience on this, is that you need to really understand that you're the last one to get paid in the capital structure. Your investors, your large institutional investors, are going to get paid first. Then you have to hit a hurdle. And after you hit that hurdle, that's when you get paid thereafter. Now, you might have it structured differently with your investors, especially if they're smaller families. However, a lot of the documents I see talk about a lot of the things as it relates to how those incentives are carved out. But more often than not, you're going to be following a convention in a fund where you're going to get paid last. And the other thing with a fund too, which I don't like, and this is interesting because this is a good question, is nobody can afford to eat, right? None of your investors in a fund want you to be working a side gig to keep the lights on, right?
Mm-hmm.
And the problem is today, everybody has a 2% management fee in there. And then when they raise money and they're groveling, what they do is they drop the management fee, or they titrate it somehow. That makes no sense, because there's inflation and everything that's going on right now, especially accounting and legal and fund administration. If you're not using fund administration, I got a great lead for you that we use to be able to do that. But my whole situation is that you have to understand, like, you have to raise enough money in a fund in order to pay yourself in order to do it. And with some smaller balance funds today, the way people are looking at it, even if you have $100 million, that's $200,000 a year. Let's just say after tax, you take home 90 grand. Is it worth the headache at that point? And then how do you hire other people? You have a lot of, overhead too that you need to pay for. So the fund structure is kind of antiquated right now, but it's kind of gone stale in family office circles, because they'd rather be direct into the investment rather than what they feel as though is some sort of, and even though you don't intend it to be that way when you communicate to them when you're raising money, they think of it as some sort of a blind fund, if that makes sense. Did I answer the question correctly?
Yeah, that's fine. So when you are investing family office funds, or, from your experience, do they tend to more often than not partner side by side in a joint venture versus invest into someone's syndication, or what's the purpose of the SPV?
They like the side by side. That's what they like. They like the pari passu. They don't like too many investors in the deal. They don't want too many people in there, because one person, you never know the sophistication of it. And very wealthy people are scared of people who don't have a lot of money, because people who don't have a lot of money, are just noisy. That's just the way it is. If anybody's ever been in retail, you never hear the complaints on $1,000 pair of shoes, always like on a, like a $50 pair of shoes or something. It's just a different audience right now. So when the opportunity comes, they like the exclusivity that I'm going to call Ruben, because Ruben has at least $100 million, right? He's a family office. That's the minimum threshold, because it costs 1% per year to manage that AUM. You have to pay, all sorts of maintenance fees and everything to manage that capital. I know that Ruben's going to come across, because he knows us. He understands the deal. He's a little more sophisticated. He's done real estate deals before. He has a problem. He has a company that's throwing off $1 million cash a month, and he needs to put it into real estate. His problem is not wealth creation, it's wealth preservation. So I call up Ruben. I said, look, I have an opportunity. I need a $2 million ticket. We're working on a Class A industrial facility in Reno, Nevada. This is operated by one of the largest, most prominent Southern California family offices, and they're putting 40% of the money down. And then you say, yes, let's do it. And then I start papering the deal and we start moving forward with an SPV and a joint venture structure. Does that make sense?
It does.
Hey,
Andy,
Ruben, let's
Yeah, go ahead.
get into. I've heard you talk a lot about the capital raising part of it. I think it's
Yeah.
I think you've got some really unique takes on who and how you should be talking to people.
Yeah.
I want to be a little bit more specific with it. Maybe on when you were coming up, not at this family office stage, but maybe when you started to figure out stuff at Goldman Sachs, maybe a little bit later, books that you put together, letters, scripts. Is there anything that you can kind of help us with on some of that stuff?
There
Because I
is.
think a
And
lot
I'll
of
tell
our
you,
audience is capital raising.
yeah, so that's something that I do day in and day out. I'm a glorified game show host. I literally sit in an office all day and I talk to investors, or I talk to sponsors, or I talk mostly to CEOs, because we haven't done anything in real estate in a while, except for one deal, because we knew interest rates were going to go up. And that was a profile I just gave you as an example of what we did. You have to know who you're talking to. And the world has changed today. And this is probably the biggest piece of advice that I can give anyone who's raising capital today. Not everybody likes real estate. And people today are very status oriented. I don't care if you're rich. I don't care if you're poor. The poor wear a lot of Gucci. The rich, I know, wear alligator leather belts, right? So there's a different way of expressing your status. And people through their investments want to express their status. However, if you're talking to someone who's highly technical and highly quantitative, they don't understand real estate at all. They really don't. It's not into them. It's not part of their personality. There's many other people who are not going to be into that too as well. But the people who are into real estate are mostly the people who look like what I call college football coaches, right? The khakis, they drink the Bud Light, they're watching their weight, they're very, very wealthy. They don't like risk, but they love real estate and they understand it because they grew up with it and that's what they understand it to be. I would never conversely talk to someone about investing in something like AI, because I would just be losing credibility with them unless there was some sort of a huge opportunity. And we have turned people over, to see the light and venture through some opportunities. But when you're talking to these people, you need to really measure their personality and be like, do you see this guy being a real estate investor or not? And the other thing that I would tell you too is when you're raising capital is not to treat your investors like an ATM. I've moved down here and I was talking to Ruben before we started recording, is that there's a lot of people here who have been watching too much Shark Tank. And I think that's done America a disservice because it's made everything very transactional. We're in a world today where we're very, very transactional, but very wealthy families and investors are relational, okay? I have relationships with top families like the Rockefellers. Otherwise, they would never have been in my third book, Investing Legacy, right, Ruben? I don't know if you got to that chapter or not.
I read the whole thing.
Okay, and other investors in there who would, some of them would rather streak naked on Broadway than to be mentioned in the book, but those who have helped really added a lot of value to the people who read that book. And in the book, I talk about the 5 different archetypes of investors. There's the provider, there's the curator, there's the documentarian, and they all talk about what they gravitate towards, right? And when you start showing them things that's not part of their personality, it's really like a personal shopper. If you're, a guy like me showing you like a pink suit, it's not really going to fit. You're wasting time, but you're also causing friction. You need to start building relationships with your investors. If you don't have a relationship with your investor, you're not going to get anywhere. And it's no different than dating or sex. If somebody says they want to marry you on a first date, which is what everybody at this Florida Venture Conference did, what does that really get you in the long term, right? It's kind of creepy. It happens. But if it's marriage on the first date, yes, we've all heard those great Hallmark stories. However, in real life, there's a different connotation to that. And you got to be willing to go out there. A lot of the people, the investors who are investing into you are not investing into your deal. They're investing into you. Okay. They just think and believe that you know what the hell you're doing and they're going to follow your lead. And you got to provide that confidence. And the way to do that is to show that you have systems and you have a fund administrator and all this kind of stuff. But you can't walk around and just expect these people to be transactional with an iPad underneath you, or just send them an email and expect them to respond. Everybody's getting bite-sized pieces of vomit today every 30 seconds. You have to make sure you're on top of them. And the only way to do that is through relationships. And as Ruben will tell you, because he's on my email list, I send an email out about every other day on good news. Okay. If you don't like it, you should not be on my email. You should not be an investor. You should not, because I built this around the interactivity, which is code for making a relationship with people. And that makes it much easier for me to go out there and raise money when I need to. Does that make sense?
Yeah, good stuff, man.
I'm following you. All right, so talk to us a little bit about the roles that a fund manager has to have for those that are coming up that want to scale into fund management, and they're thinking to themselves, "Oh, I'll just launch a fund and I'll have all the money I need for all my deals." And obviously, that's not true. But what other things do they need to know about running a fund, and particularly around administration?
I think a lot of people fail and a lot of people lose the confidence of their investors because they don't use any sort of fund administration up front. They use an accountant. The accountant doesn't know anything. The accountant really just compartmentalizes numbers, right? No offense, but let's be honest here. But they don't really take care of things the way they should. There's a company we use, and this is like a multi-million-dollar idea. And if you do like a Zoom call telling people that you hired these people to manage your real estate funds or your syndications, you'll have tremendously more credibility in the eyes of your investors for them to be repeat investors for you. It's called navconsulting.com. Just tell them Sal Buscemi at HRN referred you. And what you do is you bang your investors the price for them to set it up, which is maybe like $5,000 or $2,300 or something, but it's not coming out of your pocket, but that's the setup fee. And then this way, the investors who don't pay that fee aren't going to invest in you anyway. So it shows a micro commitment to get into the deal. And that is something I would really urge you guys to do this year, is to really clean up the fund administration. Some of you have brother-in-laws doing this, your cousins and everything, because you think you trust them. But when you have a bigger name behind you doing this stuff, it shows that you're actually growing, and that's good marketing for investors because you have to show off in front of your investors. One of the smartest things I've ever done in my life, I'll be honest with you, is we have a Class A industrial facility in Las Vegas that's really, really performing well. It's been operating for 18 months and our investors will be paid off in 1 year. Okay. Class A industrial, different credit. One of the things I did was I put together a video with a friend of mine who's an investigative journalist. And I was out there talking about the investment as if I was trying to impress my investors' friends. That video had over 1,000 hits and we only had, I think, 20 LPs in that deal. Okay. It went all around because people were saying, look, this is what I'm in. You're not in this deal. You're in some crappy, deal in Ohio that's a single family home that you're not going to get your money at. I'm more sophisticated than you are. And we call this like not just marketing, but on Wall Street, there's a convention called deal toys. And every time, a deal closes, you get this acrylic thing that's overpriced and it says, Airbnb, invested in 2016, whatever. We do it differently. I have some people who I've talked to who I've mentored, and I told them, why don't you go to City Hall? You're going to be doing a value-added deal on this apartment complex. Get the original plans, photocopy them, frame them, and give them out to your investors as deal toys. Because what happens is people come over their house for the barbecue or after church or something, and they'll be like, why do you have a picture of this old apartment building up there? Oh, well, that's my investment. And, I invested in this company. Now, their friends don't know if he owns 1% of it or 100% of it. Guess what he wants them to think? See what I'm saying? And we did another thing too, which is interesting. And if I can just tell one more story, this will really, really knock it down. In Wall Street culture, families, especially European families, nobody wants to work in August. And we had the opportunity to invest in a company called AI Scout, AIScout.io. It's the only company that Amazon Web Services showcased at their AWS this November at AWS in Las Vegas. And there's all sorts of a lot of other things that have been going on. There's the investors on this are sports owners such as Todd Bowie and a bunch of other people. And this is really, really, this is really interesting. And it's in the little guidebook too. And I'm like, how the hell am I going to get people's attention? I need people's attention. I need this. I need $1 million. We're right behind this formidable investment group called Raptor. And they were the early investors in FanDuel and Fanatics and all of that stuff. And if you look at their website, it's just incredible. Household names of gambling, vices, right? Of vice names. And I came up with the idea and I said, and I called the CEO. I said, could you call Todd and ask him, if I do this deal, could he get me signed jerseys for each investor from the entire Chelsea football club? And he said, I'll get back to you tomorrow. I didn't eat dinner that night because I was waiting for a yes or a no. And I didn't want to be pushy. I'm a New Yorker and everything. He comes back the next morning. He goes, yes, of course we can. Do you know how easy it was to pull money out when I was telling people only the investors would get an autographed jersey from Chelsea Football Club? Think about it. They're going to be putting in their basement man dens. They're going to be inviting people over. People are going to be like, how do you know the entire Chelsea football team? What I just did is increase the investor status to a point where he has to write the check because he's not even thinking about the deal. Yes, he trusts our due diligence and everything, and he has people looking at it, but he's more motivated to make the minimum $200,000 investment just to get the jersey. Does that make sense? To him, his emotion and ego is worth more. And once we did that, it became easy. And we're doing the same thing too with a Nobel Prize winner. We did a deal called Apricity Health with a very formidable CEO named Dr. Linda Chin and her co-founder, Dr. James Allison, who has a whole Amazon documentary on him. And we never got them a deal toy. And then I was waiting for the moment. And so what we're doing is we're launching a second company with a different CEO called Vectus Therapeutics. And I said, you know what? I got it. I know what I'm going to do. I'm going to give away Nobel Peace Prizes to all of our families that invest in this. And it says HRN, Vectus Therapeutics, date of investment. So now like people have 2 Nobel Prizes, right? So it's sort of like the Franklin Mint when you think of it. And when you think about your investors, you got to remember a lot of them are not going to tell you that they don't know what they're looking at, but you're going to have to really persuade them by giving them these ethical bribes the way I've done them. Does that make sense?
That's fascinating.
That's
I
great.
haven't heard about that.
So
Yeah.
can you get maybe a little bit more into the process on the team, on how you're touching your investors? Is that through, you mentioned at one point you sent articles with maybe a little bit. Are you doing that personally, or do you have
One of the
things?
things, so I don't, this is where I think needs to happen today. When you're starting out, everybody wants to be like they're a big company and be, they want to be like Goldman Sachs or something. The problem is your investors, they have investors that are big institutions, right? And you have investors who are families. And the way I treat them are like families. And one of the things I've done is because I like writing is that I've studied email copywriting. I've studied, it's not that hard, but really what you need to do is that your investors want to see you impart a personality into what you're doing. I hate seeing like the invites to the conferences to your colleague, all of this stuff. Like who reads that? I don't read it. Even if I'm on the subway and I'm bored, I'm not going to read that. It's not worth it. But you have to make the emails compelling enough so that they get open because you're building a relationship. And that's what people are investing into is the relationship. And when you do that and you communicate to these investors like you've known them for years, that really, really works. And we've been able to bring that out now where we've been able to, again, I'm a glorified game show host, but anytime we have very wealthy investors, they all have my text, I call, I text them all the time. I never bother them. I'm pretty funny sometimes. I'm like, look, this one big investor, is putting $1 million and he doesn't care about your 200 grand. Get it in by Friday. Okay. Oh yeah. Okay. Like that type of stuff. That's how, I'm always in contact with them. You have to be more informal, less formal and stodgy because people don't want to see that there's like this barrier. You know what I mean? If you're with a significant other and all of a sudden they get kind of standoffish or cold, you're like, what the hell is going on here? Be professional. And one of the things I would always tell you is that even if you're using Friend, for example, make sure you don't embarrass yourself. Always give them, even though they trust you and they're friends and everything, make sure you give them the documents first and you treat them like a professional investor and tell them like, look, I know we're friends, but these are the same docs everybody else is getting. Okay. Nobody gets any special preferences or anything like that.
Can you talk about the urgency? Because you just hit on it a little bit there, like get your money in.
So here's the problem. Every freaking thing I've seen from a novice never has a deadline on it. Never does. And when you don't have a deadline on something, first of all, nobody's going to check out of the hotel room, right? And nobody's going to buy anything. And I think a lot of people today, there's a way to do it, but you have to find your own way to do it. What I do is I make sure that they know there's a deadline. And then I repeat it again in the email, deadline, as if I'm writing to you, but it's written in a way, there's a deadline, John. Okay. You got to take it. This is it. And then I remind them of that deadline all the time. If you don't have a deadline, then there's no reason for people to take action. And I've seen people like, oh, I'm going to raise $100 million. I'm like, the hell you are. Like, I mean, and I see them like, how much you've raised before? $1 million. I'm like, how much is in the bank? Well, they're waiting for other people. I'm like, exactly. Because this guy's just sending out a PPM and expects people, and they're just telling him, yeah, I'll do it if you get another guy first, just to shut him up. And I've seen this happen all the time. You have to build a relationship with these people and tell them what's going on. And I even like my partner Albert just came here today because we have these huge family office conferences that we're going to, and we have some families in Coral Gables that we're meeting, which is why I'm wearing a suit or a jacket. Although I would for you guys anyway. The point is that these are relationships. And especially when you're working with Europeans, they're really very relationship and family oriented. They look at Americans as being selfish, right? And it's a whole different, people join country clubs in America to get away from their families. In Europe, they join country clubs to be with their families. All right. And so, you have to know the audience, but you have to build the relationship there. And you can't be afraid ever to ask for the money, but just blame someone else and be like, look, this sponsor over here is a bigger investor. We might not have anything. The last thing I want to do is give you your money back. Give me the money in before Friday, please. I really want you in this deal. Okay. It's not me. I'm just the bear, but this is what we're not the biggest fish in this deal, Andy. I need your money by 5 p.m. on Friday. I need everything. The documents are there. If you have any questions, text me, okay? Text me over the weekend. I don't care, but just let me know.
Give us some tips on capital raising, my friend.
Yeah, where do I start? I mean, there's 20 of them right there.
I've heard you talk about what you deliver to the investors, and depending on your audience, right? So engineers, you put the data room and put it all together. Most people want just a single page, right? So what do you deliver to them?
Not even a single page. So what I do is I explain everything. What I really want to do is I don't do any of that anymore. I bring them onto a Zoom so that I can talk to them myself. Like I'm talking to you, Andy. Okay. So Andy, how are you? We're going to be working with KVS. It's the 5th largest office manager in the world. I happen to know one of the descendants of it, and his name is John. He's from Jersey. And we're raising right now $50 million in the facility to allocate alongside Apollo into this huge fund or opportunity or building or whatever it is that we're working on right now. You with me so far?
I'm with you.
Are you not?
I'm with you.
Okay. So, that's sort of how I present it, is on a Zoom, because I want people's attention. And as you raise capital, and as we're in a very social, connected society today, you have to there's a corollary here that might not make a lot of sense to people unless you've been doing anything in social media. And that is, if you look at all the wealth that's being created over the past century, it's mostly driven by oil, right? Today, a lot of that wealth is in media. And if you own your own media, you're very successful, but you have to have attention. And people are paying more for attention today than they are for a barrel per oil on a comparative basis that I could draw out for you, but I'm not going to. But when you think about it, people are clamoring for attention. You need to be on top of them and get their attention all the time. And that's what a Zoom does. We're having a Zoom and I'm like, it's a closed door Zoom. We have very special people here. I'm talking to you as like, you got to meet my friend, right? And you can forward that email around, Ruben, that you got this morning to the attendees here if you want. And that would be a great example of how I'm championing one of our CEOs who we've raised 1.5 million for, who's gone his 15th exit and 8th unicorn. Okay. And you can see through the bottom of that, there's a whole video, which is a Zoom recording on it, because I want people to see and feel everything that's going on. I don't want them to see a one-page sheet. There's always a one-page sheet. There's always going to be a pitch book, and we go through the pitch book, but I'm not sitting there. You want the math? Due diligence. There's a whole data room over there, Andy. Go get it. Okay. Any questions? Call me.
So exclusivity, this is one of the ways that you get people into your rooms, because it's a special event, right? There's a special person, it's closed doors. What are some of the other ways?
Absolutely. So you gotta headline it. Some of the other ways that I like to do things, and I think for the people who are raising funds out there, you have to get into this convention of tranching. And this is something that I came up with. And when you have a deal that's really going very, very slowly, when you want to goose it up, what you need to do is you need to use a combination of deadlines and tranching. So let's just say all investors who go into Thrive before April 1st get great incentives, the best incentives. Okay. They get the best of the best. People who come in after April 1st, April 2nd to the end of the month, they're second tranche investors, and you don't get as much. You get to participate, but you're not getting the same 25% discount that, all the investors in tranche 1 were getting, or, you're paying more in fees or something like that. And what you want to do is you want to make it an inverse pyramid. So all the goodies are on top, but by the time it slows down, the people who come in last don't have much. And if you were able to tranche it and be very careful about it, then all of a sudden you're putting implicit urgency into it because you already have a deadline to begin with, right? Let's think about that. And number 2, you're giving them something as far as a carrot and the stick for them to pay attention to. And you have to plan what those tranches are and what they look like. But I guarantee you, if you were to put together a deal to a deadline and tranches for your fund, you're going to have a hell of a lot easier to raise.
All right, capital raising mistakes. What are people doing that they shouldn't be doing?
I think you can't rely on your investors to pay attention to you. And I think what you need to do is to put together presentations in a way when you're selling these deals to them that you really have to force yourself. And this is what they call it at Goldman Sachs or whatever. There's finance meetings about it, but it's called coverage banking. Okay. And if Ruben's an investor from me, that is just really, really amazing, because I'm covering him all the time. I'm calling him like, hey, Ruben, I just sent you this. What do you think about it? Hey, Ruben, can you talk about this? I think people send out an email and then they get pissed because nobody responds. You have to follow up. The real fortune in this business is in the follow-up. There's no magic to it. And the more you follow up with your investors, the more relationship you build, the more confidence they have in you, and the faster things get done. I've seen too many people just forward over legal documents to me that no one will read. No one has time today. Nobody's going to sit there and read a legal document, because it's like, and expect us to understand your deal. If you can't communicate to me on a Zoom or over the phone in a way where I can communicate it to my spouse in a telephone game, then you really need to hone in on that. And that really comes to being able to communicate clearly and being able to communicate persuasively.
Okay, so I'm going to remind you of a couple. Maybe you want to bring up one of these: the culture of knowledge building and fund management, the short-term thinker, the outsourced marketing trap, the looks only fund manager, the relationship gap mistake, the authority and training debacle, and the reluctant resource mistake. These are all from chapter 11 of Sal's book, Raising Real Money, Real Estate Funds Uncovered, which I paid like $50 for. And on Amazon, it was like $100. And now it's much more reasonable, because I believe you bought the rights back to your book.
I bought the rights back, so now it's much lower. For all of them, they're $19.95. So they're all on Audible too. The only one that I narrated was the last one, Investing Legacy, because I met a friend named Mel Robbins, and I told her that I was going to have it transfer, on voices.com. You can do it for like $1,000, and she's like, don't you dare. And it was the smartest advice I've ever gotten. So thank you, Mel Robbins, for that.
So any of those that you want to cover real quick on mistakes?
The mistakes, I'm going to go just a little top cover on that, if that's okay. And in a partnership, there's two people. There's usually people who have money and people who doesn't have money in a partnership. And what I would tell you is that when you're choosing partners and investors, I'm just being really honest with you here, you have to make sure that you are aligned on values. Okay. Today, that even means politically, believe it or not. All right. That's something that never happened before when I got into the business. When I first raised my first check at the age of 29, nobody really cared. But you have to make sure that you and your partners work together very, very well, and that you or whoever you're partnering with has a complement to you. I have a partner who is a great salesperson. He's very analytical, very quantitative, and he's great at following up and cleaning up, things and making sure things are tidy. If that's not you, then your job better be on the sales side. And that's the perfect balance when you're working with someone, is someone who's better at what you're not good at. And that's a good compliment. The problem is when these partnerships come together, these fund managers, it becomes egos, and they think one person should go one way and we should do this or not. And everybody's influenced to a certain degree. And I will tell you this, that if anyone has ever taken outside money to raise, to build their fund, meaning the GP and everything, I've seen in the past where hedge fund managers have blown up because the partners, somebody's rich uncle paid for, the legal and, the startup for the fund. However, his uncle's watching Kramer drinking beers at the country club and is making, stock calls that the other partner doesn't want to make, but he feels obligated to make because, it's the uncle who paid for it. So you got to make sure that you have an alignment of interest with you and your partners and your investors. And you also have to make sure that the investors you're with are in it and they understand it, right? There's a lot of investors out there, and I hate to say this, it's America. They might not have what you think they have. And so you're going to have to stress them out sometimes when you talk to them. And I'm not talking about a partner, I'm talking now like an LP, not a co-GP. And as an LP, you got to really say, is this someone who understands this, or is this someone who's going to get nervous and cold feet and this is their last dollar? And we're in a Shark Tank generation today where people really don't listen to what they're doing. They just think that whatever money they give you is going to come back in a multiple. And in real estate, it's rarely that, high as, comparatively speaking, to like 75x on, one of our deals, like a Municom, for example.
Good stuff.
Does that make sense?
Yeah. And Sal actually signed some of his books. So
yes,
that's fantastic.
Yes. Now that I bought the rights back. All right, guys, this has been great. I had a lot of fun. Thank you so much for your time. I hope I didn't waste your time and I didn't drift off too much, but I think you guys are pretty well equipped now to take over the world. Don't you think?
Every day we're getting stronger.
You got it, guys. All right. I appreciate your time. Brother. Thank you. Take care. That was awesome. Yeah. Thank you.
Thank you.
Legacy Acquisitions